Ever pondered on the question, how do banks create money? It's not magic, it's economics. Let's begin by debunking a common myth. Banks don't just lend out the money they have in deposits. It's not as simple as a game of musical chairs. Rather, the process of money creation is more akin to a symphony with different elements coming together in harmony. Picture this scenario. You walk into a bank and apply for a loan. The bank assesses your credit worthiness and agrees to lend you the money. But where does this money come from? Does the bank delve into its vaults, dust off its deposits and hand them over to you? Not quite. Instead, the bank simply taps a few keys on a computer and voila, your bank account reflects the loan amount. This, ladies and gentlemen, is the birth of new money. This concept, known as loans create deposits, is the cornerstone of money creation in modern banking. When a bank gives out a loan, it simultaneously creates a matching deposit in the borrower's bank account. This isn't the bank redistributing existing money, but rather it's the bank creating new money. But how can this be? Isn't money supposed to be a finite resource, like gold or silver? Well, not in the world of modern banking. In this world, banks have the power to create money out of thin air. However, it's essential to note that while banks can create money, they can't do so without limit. Banks are constrained by regulatory capital and liquidity requirements, which ensure that they can meet their obligations and maintain trust in the banking system. So, to sum up, banks don't just lend out what they have in deposits. Instead, they generate new money through the power of lending. It's a fascinating process, isn't it? But the plot thickens. The banking industry has been experiencing some significant changes recently. Banks, in essence, generate money through the power of lending, but what has changed recently? Let's delve deeper. The world has moved on from the concept of fractional banking, but why, you may ask? Let's take a stroll down the memory lane of economics to understand this shift. In the past, banks operated on a fractional reserve system. This meant that they were required to keep a certain percentage of the total deposits as reserves. If someone deposited $100, the bank couldn't lend out the entire amount. Rather, they had to hold on to a fraction of it, let's say $10, as a safety net. This system was designed to ensure that banks had enough cash on hand to meet withdrawal demands. However, modern banking has evolved, and this model is no longer applicable. Today, banks are no longer constrained by the amount of physical cash they have in their vaults. Instead, they operate under a system where money is largely created electronically. When a bank grants a loan, it's not handing over the cash from its reserves. Rather, it's creating new money out of thin air that didn't exist before. This shift has been enabled by changes in banking regulations. Banks are now required to hold risk-weighted assets, a measure that considers the riskiness of the bank's loans rather than simply a fraction of their deposits. This allows banks to lend more freely while also ensuring they have sufficient reserves to cover potential losses. But these changes weren't arbitrary. They were a response to the financial crises that shook the world, highlighting the weaknesses of the fractional reserve system. The aim was to make the banking system more resilient and prevent future crises. The shift from fractional banking has had profound effects on the economy. It's changed the way money is created and how banks operate. It's also led to the rise of new financial instruments and technologies. The banking landscape has dramatically transformed, and a crucial part of this transformation is the Basel III Agreement. This international regulatory framework for banks was designed to ensure that they maintain sufficient capital to withstand economic shocks. But that's a topic for the next scene. Stay tuned. The Basel III Agreement? Sounds complex, doesn't it? But it's simpler than you think. Imagine it as a rule book, a guide for banks across the globe, developed by the Bank for International Settlements. This set of international banking regulations is designed to prevent the financial chaos we witnessed during the 2008 financial crisis. Now, you might be wondering, what exactly does the Basel III Agreement entail? Well, its main objective is to improve the banking sector's ability to deal with financial stress. Just like a sturdy ship in a storm, banks need to be resilient, weathering the waves of economic turbulence without capsizing. The Basel III Agreement ensures banks have enough capital to cover unexpected losses. It's like a safety net, making sure banks have a buffer to fall back on. Additionally, the agreement aims to improve risk management. Think of it as a map, guiding banks through the treacherous terrain of the financial world. It provides strategies for identifying, assessing, and managing risk, helping banks make smart, informed decisions. It's about being proactive, not reactive. But the Basel III agreement doesn't stop at risk management. It also works to strengthen banks' transparency. In the financial world, information is power. The more open and transparent a bank is, the easier it is for investors, regulators, and the public to understand the bank's operations and risks. Basel III encourages this openness, fostering trust and confidence in the banking sector. You see, the Basel III agreement is more than just a set of rules. It's a blueprint for a stronger, more resilient banking system. It's about creating a financial environment that's stable, transparent, and capable of weathering economic storms. The Basel III agreement is a cornerstone of modern banking. But that's not the end of the story. There's a new player in town: cryptocurrencies. Banks are no longer the only game in town. Cryptocurrencies are reshaping our financial system. Once upon a time, banks held the golden keys to the kingdom of finance, but now cryptocurrencies are offering a fresh, innovative alternative. These digital assets, born out of complex mathematical algorithms, are presenting a new way of transacting, investing, and storing wealth. One of the main attractions of cryptocurrencies is their decentralization. Unlike traditional banking, where transactions go through a central authority like a bank or a government, cryptocurrency transactions happen directly between parties. This peer-to-peer system, powered by blockchain technology, eliminates the need for a middleman and offers a level of freedom and autonomy that traditional banking can't match. But the allure of cryptocurrencies extends beyond their structural advantages. They also present a potential goldmine for savvy investors. The meteoric rise of Bitcoin, the first and most famous cryptocurrency, has been nothing short of astounding. From being worth just a few cents in 2009 to reaching dizzying heights of nearly $60,000 in 2021, it's clear why many see cryptocurrencies as a ticket to phenomenal returns. Additionally, cryptocurrencies promise a level of financial privacy that is increasingly appealing in our digital age. While not entirely anonymous, cryptocurrencies provide a greater degree of privacy compared to traditional banking systems. This is because in the world of cryptocurrencies, transactions are tied to cryptographic addresses, not individual identities. But as with any financial innovation, cryptocurrencies are not without their risks. Their volatile nature means investments can just as quickly depreciate as appreciate. And while decentralization has its benefits, it also means there's no central authority to turn to in case of fraud or theft. Cryptocurrencies are indeed shaking up the financial world. But what does this mean for the future of banking? As we delve into this question, in the next scene, remember, while cryptocurrencies may represent a seismic shift in our financial landscape, they are just one piece of a much larger puzzle. With all these shifts and changes, where is banking headed? That's a question on the minds of many as we navigate through a financial landscape that's evolving at a breakneck pace. Banks, as we know them, are at a crossroads, caught between the traditional practices and the allure of the new age digital world. The shift from the fractional reserve banking system to full reserve banking, the implementation of the Basel III agreement, and the increasing popularity of cryptocurrencies all signal a paradigm shift. In the face of these changes, banks have the opportunity to adapt and evolve. They could turn these challenges into opportunities by embracing innovation and leveraging technology. Some banks have already begun to do so, incorporating blockchain technology into their operations, exploring the potential of digital currencies, and investing in fintech startups. However, this adaptation is not without its challenges. Regulatory complexities, cybersecurity threats, and the need for a robust digital infrastructure are just a few of the hurdles that banks must overcome. Furthermore, the shift towards full reserve banking and the Basel III agreement could potentially squeeze profitability, forcing banks to rethink their business models. Yet amidst these challenges, there are glimmers of hope. The rise of digital currencies and the blockchain technology that underpins them could open up new avenues for banking. This could range from faster and cheaper cross-border transactions, increased transparency, to even the creation of entirely new financial products and services. This journey of transformation is likely to be a bumpy one, with both triumphs and setbacks along the way. But through this evolution, the essence of banking, the safekeeping of assets and facilitation of transactions, will remain unchanged. The future of banking is uncertain, but one thing is clear: Change is the only constant. Stay tuned, stay informed, and keep questioning.